Hey, good afternoon, everyone. Welcome to the Live Econ Guy. In this video, I want to talk about interest rate risk. So I'm sure a lot of you heard about the SVB, the Silicon Valley Bank. So lots of news articles about these guys. So pretty much why I want to talk about interest rate risk is that they kind of took too much of that risk, so they didn't really leverage, and I'll explain in a bit. They weren't able to meet their depositors' needs, so people came to the bank and they tried to withdraw a lot of money and they essentially couldn't for some reason. I think I read that they needed 8% of their whatever they were holding to meet their depositors' needs, but they couldn't do that, so essentially they got bailed out. The feds ended up lending them money, and I'll explain in a bit. I'll explain more in a bit, but before I do that, let's go and kind of look at what exactly happened. So here I'm showing you guys the federal funds rate, the effective rate. So if we take a look at around the time when the pandemic started, this was at essentially zero. So the market for bonds at this time was extremely the yield on the bonds, and this is the 10-year treasuries that we're looking at here, it was very low. So as you could see, if you bought some bonds in July of 2020, you only got a 0.5% coupon rate, which is extremely low. And what happened during the pandemic is the Federal Reserve did a lot of quantitative easing. So they bought a lot of bonds, mortgage-backed securities, Treasury securities from various banks in the country, and they gave them cash. Now, when banks hold cash, they either have to lend it, they have to invest it somewhere, they have to do something with it. Otherwise, the government taxes it and takes out a lot of fees, stuff like that. So what the banks ended up doing is they went the safe route, right? So they bought government bonds. Like, what could be safer than government bonds? So they essentially bought, for a long time, banks would buy all of these bonds with very low interest rates, very low coupon rates, so like 1% or lower for a lot of the pandemic. So guys, pretty much that's what happened. They thought that they were doing a safe investment. So what happened next? Let's fast forward to today. So we have 2023, and we have the Fed essentially tightening the economy, so raising the federal funds rates. So we're currently at like a 4.57% range. So I think it's going to go a little higher. And then the Fed is saying they're going to keep tightening it. So why is this a problem? Because this kind of has a direct impact on the yield for the 10-year treasury. So in this example, some people bought 10-year treasury bonds with a 4.25% coupon. So much better deal than during the pandemic here, where you got very low yields. So why is this an issue for Silicon Valley Bank today? So I want to show you this spreadsheet that will essentially display what actually happens. So this is assuming that it's a $1 million bond. So you're buying it from the Treasury, you're giving them $1 million. And it's a 10-year bond, and the coupon rate is 1%. So guys, today the present value, and you can kind of see the formula I used. Some of the cells are hidden, but that's just the payments for every payment period. So today the present value of that payment streams, so the entire payment stream, it's $38,000 roughly if you bought with a coupon rate of 1%. Now let's imagine today you buy the same bond, $1 million bond from the US Treasury. It's a 10-year, it's a $1 million bond, and it has a 4% rate. So this payment stream that you're buying from the Fed today it's worth $130,000. But in effect, today this is worth $1 million, and it's going to pay you over 10 years this amount roughly. That's what it's valued today. Sorry. So what Silicon Valley Bank has is a bunch of these. So they have a bunch of these payment streams that today are worth $37,000. So their issue is, if this today is worth $1 million, so how much would you pay for this? If you can buy this for the same amount, you'd want a big discount to buy this. You see what I'm saying? So pretty much they weren't able to find probably any bidders for their bonds, and the issue was that they had to have the government come in and try to solve their problems. So essentially, if you haven't heard, what the government is doing is they're lending them money for these bonds that they're holding based on what they paid for them. So they paid $1 million for them 3 years ago, so the Fed is lending $1 million to them, and essentially using that 1% coupon rate bond as collateral. So kind of unfair, but personally I think it's going to be a one-off. It's going to be kind of like a warning signal. A couple of days ago I was reading an article where Janet Yellen was saying, you know, we're not bailing, we're not doing any of that again, we're not doing any bailouts. So I think it's going to be a one-off that they're doing this. It's really interesting because the federal insurance for most bank accounts is $250,000, but as this bank, SVB, they had a lot of business accounts with just billions of dollars, and that insurance shouldn't have covered it, but I guess this time the Fed is going to step in and help them out. So really interesting situation here, guys. We're going to have to see what happens in the future. I kind of mentioned in some of my previous videos that that's kind of what's going to be happening, is that the Fed is going to be slowly tightening interest rates, and these interest rate hikes, it takes a while for them to actually play out into the economy, to actually see the impact. So they say it takes like 6 months to a year for it to be felt. So last when the Fed actually started tightening was around a year ago. So right now is March 2023, and they started exactly a year ago. So we're kind of starting to feel, I'd say, these hikes right here. It's starting to manifest itself in the economy. So we have yet to start actually feeling this stuff like actually hit. So it's going to be really interesting to see how things play out. And last but not least, a lot of talk about what the Federal Reserve is going to do. Like, are they going to pivot now? Or are they going to start lowering interest rates? What are they going to do? So it's going to be really interesting. And by the way, a lot of these bonds that SVB holds and a lot of other banks is actually also mortgage-backed securities, which it's a whole other topic. You know, I made a video about this in the past. Like, you have these mortgage-backed securities and you have interest rates going up, so the value of these mortgage-backed securities is going down, the present value, but the prices of houses and housing in general, it hasn't really decreased, which is really interesting because one is going down, the other is just staying flat. And it's really interesting. If you look at the Federal Reserve's balance sheet, they have a lot of bonds, and the value of those bonds is going down from what you just saw, the little calculation that I showed you. But the benefit of the Federal Reserve is they don't have to sell any of these. They can just let them run off. Like, they don't have to, they can just print money essentially. They don't have to, you know, they don't get bank ran, so to say. So it's interesting stuff going on, guys. So yeah, I think this is going to be a one-off. I think the message here that the government, that, you know, the Fed and the Treasury Department, what they're going to be sending is, hey, you look at these guys, you see what happened, you better leverage against this stuff. You better leverage against interest rate risks. You better start buying things that are going to be doing well when interest rates continue to go up. I mean, yeah, it's going to be interesting. They're going to keep tightening the screws, and things are going to continue to start popping. You know, that's kind of how this is going to play out. Like once we start feeling the impacts of this stuff right here, and yeah, I don't think the Fed is going to be doing any more bailouts or anything of that nature. Yeah, but you guys let me know what you think. I think the Fed made it clear that, you know, they'd rather deal with a mini recession if that's what's to come than to, you know, fail at tightening, fail at dealing with inflation, because what happened in the 70s and the early 80s is that, you know, they tried to tame inflation, but then it would get out of control again. So they keep doing these bailouts. Inflation will it'll spin out of control. I don't think they want that. So yeah, more to come, guys. Thanks for tuning in. Have a great night.